Hey there, everybody. Thomas with Basecamp Trading. It is Thursday, January 31st, into the month already. And we're going to take a look today at, specifically I want to address something that comes up all the time. And this is a common misconception, and that is that bonds and the indices are negatively correlated, and you should trade based off of that negative correlation. So what we have pulled up here is bonds, 30-year bonds on the left and the S&P on the right. And the assumption that they are negatively correlated, there is a little bit of truth to that. Bonds are what we call a risk-off investment. So what you will see happen many times is when the stock market starts falling, starts selling off, people are pulling their money out and they want to put it in a safer environment. They want to put it in a safer investment. So they'll go to something like bonds or something like gold. They're taking their risk out of the market and they're putting it into a safer asset, i.e. bonds or gold. So when that happens, you do see a bit of an inverse correlation. That is not the norm though, okay? You do not always have an inverse correlation between indices and bonds. And this happens, people ask me this question all the time. Why are the indices going up if bonds are going up? Or why are bonds going up if the indices are going up? And what happened yesterday is a really good example with the Fed. It's a really good example of something that can cause both of them to climb at the same time. So the Fed came out and they said they're may not be raising interest rates throughout the year. It's going to take more consideration. There's more new things that have come up. So they may not raise interest rates. Well, when they do not raise interest rates, that means the demand for the current bond prices goes up. And when demand goes up and supply stays the same, it pushes prices higher. Now, at the same time, when they're saying they're not raising rates, that means money stays cheap and money does not get more expensive, which means it helps push the stock market higher. That's why yesterday afternoon we saw bonds spiking and we saw the indices spiking at 2 o'clock when the Fed's Powell was talking. So keep in mind, my whole point for this is do not go and blindly sell one or buy the other just because the other ones. Don't go buy the indices because bonds are going down. Don't go selling bonds because the indices are going up, because it'll hurt you more than it's going to help you. Okay? So understand that correlation is there for risk-off environments, but normally it's not something you want to just go blindly trade, which is what a lot of people do, and it's a mistake I see a lot of people making. That's why I wanted to address it today. And again, also keep in mind there's certain events like the Fed saying they're not going to raise rates that can help push both indices and bonds up simultaneously, and that's when you see big moves like this happen in both markets at the same time. All right, but that is it for today. I hope this helps. Don't forget to like and subscribe and click that little bell next to the subscribe button so you get alerts every time we post a new video here. That'll help you stay on top of these videos and keep getting the education. Hopefully these are helping you. But that's it for today. Don't forget as well, you can check out the trading room and the futures membership and the Basecamp Trading Platinum membership, where you can get futures and options and equities setups every single day for an entire month. You can get it for an entire month for $7. The link is in the description below, right down there. So I'll see you in the trading room bright and early tomorrow morning. And until next time, everybody, happy trading.